Hello, everyone. Welcome to today's lecture on international settlement. Today, we will dive into two closely related green finance instruments: Sustainability-Linked Loans, SLLs, and Sustainability-Linked Bonds, SLBs, and see how they help cross-border companies overcome financing challenges in green trade. In previous lessons, we covered various financing instruments, such as letters of credit, factoring, and forfeiting. So, what makes SLLs and SLBs stand out? By the end of this lesson, you will be able to 1. Gain a preliminary understanding of the financial core mechanisms of SLLs and SLBs, including dynamic pricing models, and become familiar with financial innovation schemes in ASEAN countries. 2. Develop awareness of ESG financial tools in green trade. Enhance your understanding of the importance of ESG compliance and cultivate professional skills to balance commercial benefits and sustainable development in cross-border trade. Let's first understand the definitions of SLLs and SLBs. A sustainability-linked loan, SLL, is a financing instrument that incentivizes the borrower to achieve predetermined sustainability performance targets through loan terms. The borrower's sustainability performance is measured using predefined key performance indicators, and if the targets are not met, corresponding penalties apply, such as higher margins or increased interest rates. A sustainability-linked bond, SLB, has certain financial and structural characteristics, where the coupon rate changes depending on whether the issuer achieves the preset sustainability or ESG targets. Essentially, SLBs are forward-looking, performance-based bond instruments similar in nature to sustainability-linked loans. Next, let's look at the background of SLL and SLB issuance. The Sustainability-Linked Loan, SLL, was jointly published in March 2019 by the Loan Market Association, LMA, the Asia Pacific Loan Market Association, APLMA, and the Loan Syndications and Trading Association, LSTA, and updated in July 2021. It serves as a voluntary set of guidelines for market participants to follow when assessing whether a loan qualifies as transitional financing. The Sustainability-Linked Bond, SLB, was issued by the International Capital Market Association, ICMA, in June 2020 as a voluntary set of guidelines covering bond structural features, disclosure, and reporting used to evaluate whether a bond qualifies as transitional financing. So, what do the model formulas for SLLs and SLBs look like? Let's keep going. After hearing this description, it may still be hard to distinguish between the two instruments. We can clarify the difference using two formulas. Let's analyze them with this table. The formula for an SLL works like a progress-reward mechanism. The base interest rate and risk premium are standard, but the probability of meeting the target can trigger a rate discount. For example, in a Cambodian rice SLL, water-saving data is verified monthly via blockchain, and meeting the target immediately activates a 30 bits per second interest rate reduction. The pricing formula for an SLB is like a risk-reward balance. The base rate provides the foundation, the credit spread adds adjustment, but the key factor is the penalty clause at maturity. For instance, in the Zhongfei leasing case, they used carbon futures to hedge SPT risk, effectively adding a shock absorber to the pricing model, ultimately achieving a 12 bits per second discount. So, what similar operational mechanisms do SLLs and SLBs share? Let's explore them together. Operationally, both SLLs and SLBs feature a crucial interest rate linkage model, which can be understood from three dimensions. 1. Target setting (SPT). Set specific, measurable, and time-bound sustainability performance targets (SPTs). For example, a steel company may commit to reducing carbon intensity per unit of product by 25% by 2025 rather than a vague emission reduction goal. 2. Key Performance Indicator (KPI) binding. The indicators must be quantitative measures that materially impact the company's sustainability, such as carbon intensity or renewable energy share, and must be audited by independent third parties like SGS or carbon exchanges. 3. Dynamic pricing adjustment. Financial terms change dynamically based on KPI achievement. Meeting the SPT may trigger an interest rate reduction, while failure could lead to rate increases or early redemption. This creates a mechanism that simultaneously incentivizes and constrains performance. Next, let's understand the key parameter calibration mechanism for SLLs and SLBs. 1. Probability of non-compliance score, beta value. The probability of not meeting the target is a crucial parameter in the model. Almost like forecasting a company's ESG performance, it estimates how likely the company is to fail to achieve its target. There are multiple data sources for this calculation. For example, the issuer's historical carbon intensity. If a company's past carbon emissions have consistently been high, achieving future targets may be more difficult. Then there is the deviation from the industry's transition pathway. If the entire industry is moving toward a green transition, but this company is off track, the probability of non-compliance will also rise. Additionally, the stringency of the SPT target is important. For instance, a goal like new CCER development is greater than or equal to 1 million tons requires prior geological feasibility verification. The stricter the target, the higher the probability of non-compliance. There are two key tools for quantifying this probability. One is Monte Carlo simulation, which estimates the likelihood of achieving the SPT based on climate scenario analysis. The other is blockchain traceability, which can track carbon emission data flows across the supply chain in real time, for example, deforestation rates in palm oil companies, making the probability calculation more precise using real-time data. 2. Penalty, reward, interest rate, structure design. Of course, the penalty and reward mechanisms differ between the two instruments. For SLBs, the penalty mechanism involves a jump in the coupon rate, usually around 25 basis points, while the reward mechanism is relatively rare. In a few cases, bidirectional adjustments are applied, such as plus or minus 15 basis points. For SLLs, the penalty mechanism typically raises the loan interest rate by 0.5% to 1%. Whereas the reward mechanism reduces the interest rate when targets are met. This is the mainstream approach. In short, SLBs lean more toward penalty, while SLLs focus on reward. But the ultimate goal for both is to incentivize companies to achieve their ESG targets. So, how are these instruments applied regionally? Let's keep going. In the ASEAN region, the implementation of SLLs and SLBs often involves country-specific indicator designs. For example, in Vietnam, attention is given to the recycling rate of solar panels, which must comply with the standards of the Vietnam Electricity, EVN. In Thailand, the focus is on the ecological biodiversity of rubber plantations, requiring certification from the Thai Rubber Authority, TFRA. In Indonesia, the emphasis is on carbon emissions across the entire palm oil value chain, which must align with the 2025 ISPO standards. In today's lesson, we have formed two core understandings. First, SLLs and SLBs are essentially financialized pricing tools for environmental performance. They convert a company's environmental performance into concrete financial terms, incentivizing companies to better practice green development. Second, the application of SLLs and SLBs in China ASEAN shows two key characteristics: standard regionalization plus technology-enabled verification. Standards are adjusted according to regional features, while verification increasingly relies on technological tools, ensuring data accuracy and reliability. I hope you gain a deep understanding of the role of SLLs and SLBs in green trade, building experience for future work in this field. Finally, please complete the following exercises. This concludes today's lesson. See you next time.